Okay, so today we're going to be looking at problems involving cost of capital. We're going to be using the Brigham Houston 12th edition Fundamentals of Financial Management as a foundation for problem solving. Here we'll be looking at chapter number 10's question 10-12. So the Midwest Electric Company uses only debt and common equity. It can borrow unlimited amounts at an interest rate of 10% as long as it finances at its target capital structure, which calls for 45% debt and 55% common equity. Its last dividend was $2. Its expected constant growth rate is 4%, and its common stock sells for $20. MEC, that's Midwest Electric Company's tax rate is 40%. Two projects are available. Project A has a rate of return of 13%, while Project B's return is 10%. These two projects are equally risky and about as risky as the firm's existing assets. Now, this is the entire background to this particular situation. What we want to understand is what is its cost of common equity, what is the weighted average cost of capital, and which projects should Midwest accept. And these three are fundamental questions to financial management, and they help us understand when we have resources available, how should we be utilizing them. So when they say what is the cost of common equity, understand that we're talking about the component that we often refer to as RC. R refers to the cost, and E in this case refers to the cost of equity. And also remember that there are three methods to calculate the cost of equity. In this particular case, we're going to see what information we have available in order to determine which method of cost of equity we're going to use. If we come towards the information that is given regarding the equity, it says its last dividend was $2. This means that D0 is equal to $2. Its expected constant growth rate is 4%. Expected constant growth rate is 4%. This means essentially into the near future we can expect that the stock will continue to grow at 4%. And its common stock sells for $20. This is its price today. Its common stock sells for $20. Based on the information that we have available, we want to be able to calculate this cost of common equity. Now, this cost of common equity can be calculated using the dividend yield and growth rate approach. In the dividend yield and growth rate approach, we know that RE will be equal to D1 divided by P0 plus G. In this case, we have P0, that's the price today. We have the constant growth rate, but we don't have the next expected dividend. But remember that if you have D0, that's $2, and we have the constant growth rate, we can calculate the next expected dividend by multiplying the prior dividend by the growth rate. So that would mean 2 multiplied by 1.04. So if we do this, that will be 2 multiplied by 1.04, and we get 2.08. This is the next expected dividend. Now that we have the dividend, we can calculate the cost of equity by plugging in all of the values. So that would be 2.08 divided by 20 plus a growth rate of 4%. Don't forget to convert the percentage into a decimal. So what we want to do is 2.08 divided by $20, and we want to add into it our 0.04 or our 4%. Our answer is 0.144. When we convert that into a percentage, we get 14.4% as our cost of common equity. So this is your answer to part A. Now in part B, they say what is the cost of the weighted average cost of cost of capital. Remember that in this case, because we're dealing with only debt and common equity, our weighted average cost of capital contains only two components. There's the after-tax cost of debt, as well as I forgot to add the weight there, as well as the cost of common equity. Okay. Now, in this particular case, the weights are going to be calculated by the capital structure. And in the question, they specify the target structure at 45% debt and 55% equity. That means that WD will be equal to 0.45 and WE will be equal to 0.55. So we've got our weights right there. Then comes the element of the cost of debt. Now, at what rate can our firm borrow so long as it finances this capital structure? That's at 10%, so that's 0.10. And the tax rate for this particular firm is given at 40%, so that will be 0.40. Now, essentially, we have all of the components. Combining the information from Part A with the information given in Part B, we can calculate the weighted average cost of capital. So what we'll do is we will plug in all of our information using this particular formula. So the weight of debt is 0.45. The cost of debt is 0.10. 1 minus t will be 1 minus 0.40. This is the first component of debt, the after-tax cost of debt. And then we have the cost of equity, where the weight of equity is 0.55. And the cost of equity is, as calculated in the last part, 0.144. Multiplying all of this one by one, so we'll do 0.45 multiplied by 0.1 multiplied by 0.6, and our after-tax cost of debt by weight will be 0.027. And for the second component, we have 0.55 multiplied by 0.144, and we get 0.0792. Adding both of these two components, and we get 0.1062, or a cost of capital of 10.62%. So this is Part B, the weighted average cost of capital. Now let's look at Part C. In Part C, it says, which projects should Midwest accept? Now remember one thing. If the capital that your company is going to raise costs you a certain amount, the projects that you can invest in must have a greater profitability. In this particular case, you have two projects. You've got Project A and you have Project B. Now, Project A gives you a rate of return of 13%, while Project B gives you a rate of return of 10%. Keeping this information in mind and the fact that we've calculated a weighted average cost of capital of 10.62%, that means that we want to select a project with a greater profitability than 10.62 because this is our cost of capital. So that means that automatically we will select Project A, and the logic is very simple. The return of Project A is greater than our cost of capital. Okay, please drop a comment if you didn't understand anything in this particular question. Thank you.